Welcome to the MUFG Global Markets FX Week Ahead podcast with Lee Hardman, Senior Currency Analyst at MUFG. It's Friday, 6th March 2026, and joining Lee to pose some questions on the financial market themes for the week ahead is Abdul-Ahad Lockhart, Currency Analyst at MUFG. This material is only intended for professional investors in jurisdictions in which its use is permitted under applicable laws, rules, and regulations. It has been produced for information purposes only and should not be construed as investment research or advice. MUFG EMEA disclaimers and disclosures can be located on our website.
Hi, Lee.
Hi, Abdul-Ahad.
So it's been a volatile week for financial markets, triggered by the conflict in the Middle East. How have developments impacted the FX market?
Yeah, like you said, it's been a very volatile week in markets. Obviously, the main spillover channel from the Middle East developments into the FX market has been through the price of energy. We've seen the price of oil jump by almost 30% over the past week, and natural gas price as well in Europe has jumped by an even bigger amount, by 70%. So this is clearly having more of an impact now in terms of FX performance. It certainly helped the dollar to rebound after a weak start to this year. There are a couple of reasons why we think the dollar benefits from higher energy prices. One, the US economy now is a net exporter of energy, whereas European and Asian economies are bigger importers of energy. That means that when energy prices jump, that has more of a negative impact on European and Asian economies, helping to boost the appeal of the US dollar. Secondly, the higher energy prices has also prompted the US rate market to scale back expectations for further rate cuts from the Fed at the start of this year, which has been putting some upward pressure on short-term US yields and the dollar. And then finally, on top of that as well, we've also had the positioning angle, which, as we said, most people, including ourselves, had been bearish on the dollar at the start of this year in anticipation of further weakness. And this rebound for the dollar over the past week has certainly triggered a squeeze of those short dollar positions. The leverage fund positioning did indicate that short dollar positions had reached the highest level since back in early 2022. So I think when you put all of those factors together, it does make sense that the dollar has staged quite a strong rebound this week, although we would still say it hasn't really broken out of recent established ranges. The dollar index is still in the kind of 96 to 100 range, where it's been since the second quarter of last year. But there is obviously an increasing risk that if oil prices and energy prices continue to surge higher in the weeks ahead, we could as well see the dollar as well stage an even bigger rebound. I know, Abdul-Ahad, you've also been looking into the performance of FX during prior oil price shocks. Be interesting to hear your findings from your studies.
Yeah, thanks, Lee. Yeah, so this week, against the backdrop of the ongoing conflict in the Middle East, we examined how G10FX historically responded to sharp oil moves, and how this relationship has structurally changed since the beginning of the US shale industry. So our framework assumes a simple linear relationship, estimating an oil beta for each G10 currency. This allows us to quantify how much currency typically moves in percentage terms when oil moves by a given amount. So a key element of the analysis is recognizing the US regime shift. This difference between pre-shale and post-shale eras. So the shale revolution refers to the rapid rise in US oil and gas production enabled by horizontal drilling and hydraulic fracking. Pre-shale, 1999 to 2011, was a period in which the US remained a declining oil producer, heavily reliant on imports. Oil shocks in this era were largely interpreted as global demand impulses, typically associated with risk-on behavior. Correspondingly, in our results, we observe commodity and high beta effects tending to appreciate during large oil up weeks. So during the post-shale 2012 to present, this era marked US transition into a major marginal supplier of crude oil. As US shale output ramped up, the nature of oil shocks shifted. They increasingly reflected supply dynamics, geopolitical disruptions, and inflationary pressure. Rather than pure global demand, This made oil spikes more dollar supportive and far less reliably positive for commodity effects. This regime shift underpins the collapse of traditional relationship and the emergence of a negative oil relationship for euro and Swissy. So based on our estimated post-shale betas, euro dollar and Swissy exhibited oil betas of approximately 0.05% negative and minus 0.07% per 1% oil move respectively. Therefore, if crude was to rise by 20% over the following week, our model would imply an expected depreciation of euro dollar by 1.4% and an expected depreciation of Swissy by negative 1%. These results reflected the post-shale environment in which higher oil prices tend to amplify dollar strength against European currencies, driven by negative terms of trade effects, where oil plays a central role in Europe's industrial cost base and consumption basket. So, Lee, Fed rate cut expectations have been scaled over the past week in response to upside inflation risks from higher energy prices. Do you still expect the Fed to lower rates this year?
Yeah, it's a good question. Like you say, I think the market has been pushing back expectations for the timing of the next Fed rate cut in response to the energy price shock going on in the Middle East. Obviously, from our perspective and the Fed's point of view, obviously they're watching closely to see how long this energy price shock persists. Obviously, the bigger the move higher in energy prices and the more persistent higher energy prices are, the more the Fed would be uncomfortable to lower rates further this year. Having said that, though, today we've also just had the release of the latest payrolls data from the US for the month of February. Did show a significant slowdown again in employment growth at the start of this year, reversing all, if not more, of the gains that we saw in January. So if you take the 2 months together, which have been very volatile at the start of this year, it does point towards private employment growth of around sort of 20 to 30,000 per month on average, which to us historically is still very weak. I think it does sort of raise questions again about the health of the US labor market, and that's something which the Fed will need to watch very closely. If we continue to see such weak employment figures in the coming months, it will put pressure on the Fed to consider lowering rates further. And like you say, with inflation risks also increasing at the same time, the Fed is being put in a more challenging situation as the threats to their dual mandate are diverging. I think the Fed would tend to have to put more focus on the labor market if that really does continue to deteriorate and to cut rates further, which is still our view. But like I say, the inflation dynamics certainly make it more challenging for the Fed to keep cutting rates in the near term, and that is helping to provide some support for the dollar as well. But we don't see a similar scenario to back in 2022. Obviously, on that occasion, after the Ukraine conflict started and we saw another big energy price shock during 2022, the Fed was very quick to raise interest rates. Their policy rate started closer to the zero bound, and they raised rates aggressively by over 400 basis points in 2022. And that was a key reason why the dollar strengthened so sharply by about 20% in 2022. Whereas on this occasion, we would argue that the policy rate is already in kind of mildly restrictive levels, and that there isn't the same pressing need for the Fed to consider hiking rates as quickly on this occasion. So thanks for listening to today's podcast, and thanks, Abdul-Ahad, for joining us as well. Have a good weekend, everyone.
Thank you for listening to this MUFG Global Markets podcast. Rate, review, and subscribe. Contact your MUFG sales rep for more information. Come back next week for more insights from the Global Markets Research team.